Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. Today's video is a special one, for me at least, because it marks the beginning of an educational series that is going to be shared on this channel, as I mentioned in this community post that hopefully a lot of you have read by now. And within these videos, we will look at basic to advanced explanations of concepts you have heard of and how to implement them in your day-to-day trading. Before we get into the video, I'd just very quickly like to reiterate what I have written here on my YouTube a while ago, because there are still some fake comments or impersonating comments going around and sharing some fake WhatsApp numbers, trying to get you to contact them, and I'm assuming trying to scam people. I'd just like to put this out there yet again, that I will never give out my WhatsApp number. If you message me, I will reply majority of the times with a voice note, so always ask to hear our voice, and please never fall for these fake comments. I don't have a course, I don't have a mentorship, I don't do any of that. It's just YouTube, so don't fall for any of these impersonating or the fake comments. Now, this video will focus on liquidity or order creation, why they are important for institutions, and how to spot and trade them on a day-to-day basis. So without further ado, let's go ahead and jump straight into it. Now, I'd just like to reiterate that by liquidity in this video, or in this case, we are not actually talking about the amount of money or the amount of orders that's entering the market. That's not actually what we are talking about. By liquidity in this case, we are talking about where majority of the orders are being created on the sell side or buy side, and where majority of the stop losses are at that given time. So what actually is liquidity? This is probably one of the most accurate definitions that I have come up with for liquidity, and it says it refers to market behaviors that would entice a group or majority of traders at that given time to execute orders in a certain direction, allowing institutions to complete their own orders upon manipulation of such behaviors. Now, I know that was a wordy sentence, but let's break it down a little bit together. Refers to market behaviors that would entice a group or majority of traders to execute orders. That could be any behaviors like support, resistance, trend lines, market patterns, which we're going to speak about in a bit. Allowing institutions to complete their own orders upon manipulations of such behaviors. So there's certain market behaviors that form, that entice a big majority of the people to either buy or sell the market, which in turn allows the institutions to manipulate those and open their own orders without ruining the market balance. By liquidity, we also refer to the quote-unquote retail stop losses, or where the stop losses of a lot of the, again, quote-unquote retail traders are placed. And it's important to also note that liquidity can also be in form of pending orders. So buy stops, sell stops, buy limit, sell limit, all of these can be forms of liquidity as well. There are many different behaviors that result in order creation or liquidity creation, majority of which you already know. Levels such as support level, where people trade maybe the second, third, fourth, fifth, whatever touch of that support zone and put their stop losses below. So that's downside liquidity. There's stop losses below. There's a pool of money resting below here. Same with the resistance, where people trade the sell side and put their stop losses above. Same goes with trend lines, where people trade the third, fourth, fifth, whatever touch of that trend line. And if it's going up, they put their stop losses below and trade the bullish side, and vice versa for the bearish trend line. But liquidity also gets introduced in forms of more advanced, quote unquote, advanced retail concepts such as Fibonacci and market patterns. Many times the institutions would be pushing the market in a direction to validate certain fib levels, then pushing the market in the opposite direction. And if you have studied Fibonacci, you would know that strategy to strategy is different. Some traders trade based on this pocket, some traders the 50 to 61.8, some other traders from the 786 to 886 mark, but unfortunately it doesn't tend to give us as much consistency as we'd like to see. Now, I'm not going to go into too much detail about Fibonacci, because a while ago I released this video about does Fibonacci really work, speaking about different fib levels and speaking about is it actually reacting off a Fibonacci level or something else that has taken place in the range. And finally, market patterns, all of these Forex patterns that you have heard of, that you have probably traded at some point, all of these are methods of trading that do not actually work over the long term, and it's simply there to do one thing: create liquidity, manipulate the retail out to allow institutions to open their position. Talking of institutions, let's now actually discuss why liquidity creation is extremely crucial for them. First, we have to understand that the market at any given time needs to retain an element of balance. If not, it would just continue to go in one direction non-stop. It will just be one straight line or one big candle pushing in a given direction without it pulling back. So that element of balance needs to always be retained. And even at times where the market is extremely impulsive and it creates huge imbalances, however long it takes after that, oftentimes you'll see the market come back up and fill those imbalances. So institutions cannot just go ahead and open 100,000 lots and push the market in whichever direction that they please. It doesn't work like that. There are laws stopping them from doing so. So, for an institution to be able to short sell a market without necessarily ruining the market balance at that given time, first they have to create upside liquidity. First they have to entice a lot of traders to take the sell position before they do. That can be in form of any of the behaviors that we just spoke about in the previous slide. But when the retail is being enticed to sell the market, there is a specific level, specific zone that they are trading based on, and oftentimes their stop losses are above that level, which means there's a pool of liquidity resting above that retail sell level. As I'm sure a lot of you know, when you sell the market, your stop loss works as a buy order. It means if you sell it at, for example, let's say 1.6, I'm just going to make it easy. If you sell it at 1.6 and your stop loss, for example, is at 1.61, when it hits 1.61, all of your sell orders are going to be transitioned back into a buy order. You are buying back your orders at a higher price than you initially sold it at. That's why you end up losing money. So if there is 100 million people, not 100 million, let's say 100,000 people selling the market at a given time with their stop losses above, once those stop losses get hit, all of those orders transition into buy orders. It's as if there's more demand all of a sudden being pumped into the market because those stop losses have been hit. So once a behavior is created and the retail is on the sell side with their stop losses above, and once they get manipulated, the institutions and the big players can now rebalance the market by entering their own sell position. Again, there's many sell positions being executed here. Stop losses are above. Stop losses get hit. All of those sell positions turn into buy positions now. There is a lot of buy power, a lot of demand into the market. All the institutions need to do now is open up their own sell positions, rebalance the market, and allow the market to go in its direction and profit off those trades. Very simple. And this happens on a day-to-day basis, even at times that the institutions need to close their own trades. So if they're in the sell side, and they want to get out of their trades, naturally those sell positions are going to turn into buy positions. So a lot of the times what you see happens is the institutions will end up creating downside liquidity before they end up getting out of their own trades. So there might be, for example, a zone of support. Let's say they have actually sold it at the top over there, they've manipulated to the upside, and now they're in the sell side. Oftentimes, you'll even see the market create downside liquidity like a zone of support, trend line, whatever, those behaviors that we spoke about. And now the institutions want to get out of their sell orders, so there's a lot of buy orders being created on the retail on this side. Once these buy orders get manipulated, all of these buy orders will turn into sell positions, right? When we said over here, sell positions hitting stop loss equals buy positions, it's vice versa over here. Buy positions hitting stop loss equals sell orders. So once they create downside liquidity and once they manipulate that downside liquidity, now they have introduced even more sell positions into the market on top of their own sell positions at the top, which allows them to simply close those sell positions and rebalance the market again over here. I hope this explanation made sense. This was probably one of the most important breakthroughs I had in my own trading. But although it was a very important aspect in my own trading, it's important to note that we do not know how many times a manipulation may occur. The market can manipulate a zone many times. It can just keep manipulating up, manipulating up, manipulating up, manipulating up before they move back down. We don't know how many times that manipulation may occur because institutions will manipulate a given level as many times as they need to make sure enough orders have been taken out to allow them to open their own positions. But to be fair, we don't even necessarily need to know how many times the level gets manipulated. As long as we have good information about liquidity and good risk management, it really doesn't matter. Now, for you Wyckoff traders out there and for people who enjoy this style of trading, you have to know that liquidity in a ranging market is one of the most important things in our trading. The institutions can keep a market consolidating for as long as they want to create more and more orders. This is where a good understanding of liquidity helps us to know if a ranging market is likely to go up or down, and not necessarily having to trust these market patterns where, for example, they just draw a random consolidating zone and they say, oh, if it breaks up, trade it up. If it breaks down, trade it down. No, we're not breakout traders here. We are logical traders. And when you look at Wyckoff schematics within themselves as well, you would know that there are many different levels. As this whole schematic is being created, there are many different levels that get manipulated. Just from a trend line perspective, you've got many different trend lines that get formed within the range, many different manipulations that occur within that given range, whether it be on a smaller scale like these trend lines over here, or whether it be on a slightly larger scale, which would be these type of trend lines coming back down over here, or the huge upside liquidity, for example, that may be created in a distribution, or in this case, a lot of downside liquidity that gets created within an accumulation with the continuous manipulation of that to the downside. But it's more than that. Within these levels itself, within these little ranges, you tend to continuously see more and more manipulations. And believe me when I say, as long as you pay enough attention to these factors, almost 100% of the time, you would have a good idea of where that consolidating market is likely to go. Again, we don't even need 100% accuracy. That's honestly not my aim. 50% would be enough, would be perfect. But once you pay attention to where liquidity is being created within that range, how it's being manipulated, whether or not after that manipulation you're getting a relevant break of structure or not, all of these factors add to our consistency in trading consolidating ranges as well. So hopefully by now you have a good idea why we pay so much attention to liquidity, but it's still very important for us to know some do's and don'ts when it comes to liquidity for our day-to-day trading. Do not use liquidity as a direction defining factor. I see this so much with smart money traders that as soon as they see some equal highs, they think the market has to go up. Some equal lows, they think the market has to go down. Some trendline liquidity, they think the market has to go and manipulate it. Fair enough. At some point it may, but we should never use that as a direction defining factor for the trade that we are going to be taking on that day. You should have other forms of analysis that will help you with direction, such as market structure, such as order flow, such as Wyckoff schematics, etc, 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 and we will only use liquidity as an extra confirmation within our trading. So never think to yourself, just because there's equal highs, the market has to go and manipulate it there and then. Institutions can keep that level open as long as they want to. And I'm pretty sure if you have been one of the smart money traders who uses liquidity purely as a direction defining factor, you would agree with me when I say it doesn't seem to be as consistent as you like it to be. So instead of that, use liquidity as a confirmation. Also, do not use liquidity captures as an excuse for reversals. So in addition to what I said about it's not a direction defining factor, once the equal highs or equal lows get manipulated, that is not necessarily an excuse for the total reversal of that market. They can create equal lows, they can go ahead and manipulate those equal lows, but perhaps that wasn't necessarily the direction that they wanted to take in terms of reversing it to the upside. So instead it will just come back up, tap off some supply, and then down it goes again. So we shouldn't use liquidity captures as an excuse for reversals. All in all, never use liquidity as a direction defining factor. Majority of the times your direction should be decided in your mind, and then you will use liquidity to have better entries, to have more idea of when to get out or when to get in, etc, etc, etc. However, do use liquidity to validate your points of interest only upon other confirmations. I'm pretty sure you've experienced this when you're looking at a range and you have multiple different points of interest that you don't know which one to trade based on. And what I'm about to say doesn't happen all the time, but it's a scenario that is very helpful once you manage to spot it. You will see the market create liquidity above or below a point of interest, depending on whether it's a supply or a demand zone. And the reason for that is to entice traders to get in a bit earlier. Then upon their manipulation and rejection of that zone of supply or demand, the institutions can get in their own positions. So a lot of the times we like to use liquidity to validate our points of interest, again, as long as we have other confirmations. And the reason why I keep reiterating that you need extra confirmations is because this is not a secret formula. People in this industry like to find one given strategy or one given secret formula that's going to completely revolutionize their trading. This is not it. In fact, you will never find that. So I keep saying other confirmations so you don't end up just jumping on the charts and identifying any and every zone of liquidity and taking trades based on those. But having said that, a lot of the times we do use liquidity to validate points of interest that we want to trade based on, and do use liquidity on all time frames. Remember, markets are fractal, so whether you're on the second base time frames or the weekly time frames, liquidity is something that can be used on all time frames. But just remember the range that you are trading. So don't all of a sudden identify a 1 minute liquidity and then try and trade that to the daily zones. It doesn't work like that. And just so I can go into a little bit more detail about the fractals and what I meant by that, imagine you have a trend like this coming down on the higher time frame. So this is what you see on the higher time frames, and more or less this is kind of what you're seeing on the lower time frames. So you're analyzing it, you're realizing you had elements of equal highs before, you had manipulation of those equal highs, and then the market successfully created a new low. It went all the way to the downside and created a new low and left the zone of supply open at the top. Now you're wondering what type of trades you can be taking. You keep analyzing the market, you realize the market also left equal highs open within the range. So now you have an idea that potentially that level of supply could be a very good level for you to want to take a trade based on and trade this to the downside. But obviously there's going to be liquidity within the range, within this final impulse coming up, this retracement coming up. There could be liquidity creating within these smaller ranges on the lower time frames as well. So you have maybe an element of a small accumulation at the bottom over there to sponsor the price back into the supply. You have liquidity resting above the accumulation and manipulating that liquidity. So now we are looking at two different scenarios. We are looking at this liquidity capture and rejection of this zone of demand, and this liquidity, the capture of this liquidity and this zone of supply. When I say pay attention to the range that you are trading, this is what we are talking about. Because if you're trading based on this supply, based on this liquidity capture, chances are you will be able to extend your take profits at or below this final low. Because at the end of the day, you are seeing the higher time frame behavior, you are seeing the market is in a bearish trend. So it's as if the range that you're focused on is a higher time frame range and you're trading based off the highest levels of supply within that range, a big liquidity capture within the range, and then you can extend your take profit again at or below this low. Whereas if we are focused on this liquidity capture at the bottom and the rejection of maybe a small accumulation that, let's say, took place over here, this is now a completely different range that you're trading. We can call this a counter trend trade. Yes, relative to higher time frames is counter trend, but perhaps on the lower time frames you've seen relevant breaks of structure. So relevant to, let's say, 1 minute or 3 minutes, you're actually trading with that current trend. You just have to remind yourself that the range that you're trading in this case is much smaller than the sell side from the top over there. So once you manage to get yourself in some buy positions to the upside over here, you have to know you need to get out either at the equal highs or as it's approaching your level of supply. We shouldn't be ambitious to think to ourselves, just because there was liquidity, just because there was manipulation of those liquidity, we are now able to extend this above the previous highs. No, you always need to pay attention to the relevant range that you're trading and where to get out. These are very important when trading liquidity or when adding liquidity to your trading strategy. Now, just so we can have a few chart examples before we wrap up this video, I just want to go through maybe 2-3 trade scenarios, which to be honest with you, I was planning on creating shorts on these and creating some longer videos on these as well, and actually I still probably will, so I'm not going to go into too much detail about why these trades were executed. You will be able to see that in future shorts and a future long video, but this is exactly what I mean about knowing the range that you are trading in the market. So this was a hedge scenario where initially the buy position was executed to help us gain a hedge scenario from the supply at the top and sell it back down, and the buy scenario, by now hopefully you can see how liquidity was used to validate that point of interest at the bottom, where we had Frankfurt open, create a level of demand, sponsor the price all the way to the upside, and as it did that, we created a trend line, first touch, second touch, the third touch of the trend line. You can even see it over here. The market bounced up. This is all enticing traders to get in buy positions, only for it to come back down, manipulate that trend line, reject that Frankfurt accumulation, and then sponsor the price higher and higher and higher. Now we need to know what range we are trading, because now I'm trading based on a Frankfurt accumulation, more or less in a bearish market. So I need to get out once it starts to manipulate some equal highs or once it starts to tap off some levels of supply. This is staying relevant to the range that you're trading. I'm counter trend trading on the higher time frame, so I need to make sure I get out at the levels of supply. And this sell back down from here, again, we have to remind ourselves the range that we are trading. Now I'm trading based on on a high level of supply. Once some highs have been manipulated, not just these, but this high as well, and even this one. So it goes without saying that when we are trading with the higher time frame trend, we can now extend our take profit at or below this low as well, which is exactly what took place. And now this GBP JPY trade, which was a very interesting one for me as well, simply because it was executed within a consolidation range. It was a very short-term trade, just a quick 1 to 8 or 1 to 9 as far as I remember, yeah, to the upside. But again, we just have to pay attention to what ranges we are trading. It's very simple. We are consolidating, so the market is going sideways. That's your range at the end of the day. When you pay a bit more attention to this consolidation range, you can see other levels of manipulation to the downside, rejection of levels of demand, and the price being successfully sponsored to the upside. So now that I'm trading this consolidation, naturally this is my range, right? From this low to this high. That's the whole range that I will be trading. So I will either have to wait and see if it comes down to these points of interest and take it based on these levels. We had good reasons why we didn't want to wait on these levels. And honestly, if I want to go into detail about this now, it's going to be another half an hour on this video. But believe me, I will. As I promised in that community post, I will. I'm going to literally reveal everything in my trading. So long story short, London opened in this case, gave us a tiny little accumulation and started to sponsor the price up. In this range, it created upside liquidity. And I saw these equal lows as downside liquidity as well. So now I just pay attention to the exact range that I want to trade. I know we're consolidating. I know practically my range is from down here to up there. Or if I want to make it even more accurate, my range would be from this low to this high. So now I just need to know if I'm trading the bullish side of this, I need to get out as it's approaching levels of supply. The range is consolidating, so I shouldn't get brave and just want to extend this to the high heavens. And to be fair, in terms of take profit, this was an easier trade because once it took the lows and rejected that zone of demand and we got in the trade, it actually created upside liquidity in this case. Came all the way back down to the entry. I was still in the trade, still not broken even, decided to keep it open because of the upside liquidity created right below this 3-minute candle. Let me zoom in so you can see it slightly easier. This Asian open candle that was created at the top over there. And eventually it was successful. He ended up going to the upside, manipulating those equal highs and tapping off that supply. And that's where we got out of this trade. To be fair, I say it was easier to judge the take profit of this trade because this was a Friday trade. So obviously I'm not trying to keep this tiny little trade within this tiny little range open over the weekend, at least that full volume. So naturally, once it taps off those supply levels, we have to start to close partials or close the entire position, which was the right decision as well because the market gapped down and then actually ended up going all the way to the upside over there. So if there was other entry opportunities, we would have been able to get into them throughout the week after. With these 3 specific trades that you saw, as I mentioned, there will be shorts recorded on them. There will be more breakdown on them. I just didn't want to divert this video's attention from liquidity to just another random trade breakdown. The point was looking at these scenarios and seeing how liquidity was used on different levels for us to know where we can get in, validate some points of interest, shall we remain in the trade or not, and where we can actually get out or where we should get out. So I hope you got value from this video. I hope this information painted a clear picture as how you can use liquidity in your day-to-day trading and how you should and shouldn't be using liquidity on your day-to-day trading. Remember, you are your biggest teacher in this industry. You have to take these concepts and backtest them in your own time. You might figure out things for yourself that are much better than what I'm teaching. So if you got value from the video, it would be great if you can press the like button down below. Let me know in the comment section down below if you heard something in this video that gave you that aha moment or gave you that light bulb moment. But with that being said, let's elevate and let's catch some pips.